Many thanks indeed to Katrina. Thank you for helping to set the scene today. There's a lot of detail in there. One thing that struck me was the level of capex in the oil and gas companies. I hadn't seen that slide before. I was on my way to Singapore watching a movie about the rise and fall of research in motion, which some of you may remember made the BlackBerry. And I wonder whether the oil and gas companies, if they don't adapt to the changing environment and their business models might be going the same way. We'll see. Our next session is another presentation. This one will be carried out by my colleague, Nikhil Sanghani, who is the Managing Director of Research at OMFIF, who will present the findings of the work that we do in terms of research on the investment approaches of global public investors, especially towards sustainable and transition finance. So, Nikhil, please come to the stage.
Good morning all, and thank you for joining us at this event today. As mentioned, I'm Nikhil Sanghani. I'm the Managing Director of Research at OMFIF. And for the next 15 minutes or so, I'll be going through some of the key findings of two of the big surveys we run at OMFIF of global public investors, namely central bank reserve managers and public pension and sovereign funds. And I'll be going through the findings that closely relate to the topic of sustainability and transition finance. So just to give an overview of these surveys and the projects that we run at OMFIF, the two projects as mentioned, the first is on central bank reserve managers. We call this GPI, or Global Public Investor Survey. And the second one is the Global Public Pensions and Sovereign Fund Survey, or GPP, Global Public Pensions for short. For the Global Public Investor 2023 report, we launched this earlier this year. It is based on surveys of 75 central banks across the world with almost $5 trillion worth of assets. The Global Public Pension Survey, we'll be launching it at the end of this month, actually. It's informed by not only a survey, but we have interviews and other insights from some of the biggest funds in the world. And they total close to $3 trillion worth of assets. And what this means, if we take a step back, is that at OMFIF, through these two reports, we have a better understanding of the investment intentions, including on ESG, of funds worth almost $8 trillion in total. And I'll be giving you some insights on both the paper that we've already published on the GPI, but also a sneak preview of some of the findings for our GPP report that will be launched on the 30th of November. So let's start by considering how prominent sustainability is to these public investors. The first slide here is based on a question that we ask about the most important economic factors that are affecting the investments of reserve managers over the next 5 to 10 years. The light blue bars are showing the most important factor, the dark blue bars the second most, and the gray bars the third most important factor. The length of the bar therefore shows you how much each of these factors are within the top 3 of reserve managers' concerns. I've highlighted here in red that climate change is somewhere in the middle of these concerns. It's not as important as geopolitical tensions or inflation for central banks. I always find it interesting when central bank reserve managers are telling us that they're concerned about inflation, when, of course, those are the organizations that are tasked with getting it under control. But as mentioned here, climate change is somewhere in the middle of these concerns. So it's not as pressing as those other two factors mentioned, but it is more important than, say, technological change or demographics to them. And it's a similar story when we consider the pension and sovereign funds. So this is the same chart and the same question. Again, for this group of investors, the lighter blue bars are showing the most important factors, the dark blue second most, and the gray bars the third most important factors. And you can see here, climate change, again, is somewhere in the middle. Inflation is the top priority and top concern right now. Equilibrium real interest rates is also a top concern. That's part of this narrative that seems to be a pressing concern around higher for longer interest rates. And geopolitics is high up there as well. Climate change, again, more important than technological change and demographics, but it's sort of in the middle there. What does this mean? It means that climate change isn't necessarily keeping these investors up at night, not right now at least, but it is in factoring as part of their thinking right now. It's a middling concern for them. Which begs the question, what are they doing about it right now? This chart here shows how the different types of global public investors are implementing different types of ESG criteria. The public pension and sovereign funds are shown in light blue, and in dark blue are the insights from the reserve managers. And there are two key messages that stand out from this chart. Firstly is plainly obvious to see. The light blue bars are higher than the dark blue bars for every type of ESG criteria, whether that's internal ESG integration into portfolio decisions, whether that's negative screening, whether that's positive screening. Pension funds and sovereign funds are doing more. And often that's related to the more restricted mandates of central bank reserve managers. In fact, if you see towards the right-hand side of this chart, 35% of them say that they do not implement ESG whatsoever as part of their reserve management. But the second point that's worth highlighting, if we just focus in on the sovereign and public pension funds in the light blue bars, is that it's more a case of incorporating ESG into their existing portfolios rather than actively investing based specifically on ESG criteria. For instance, the share that undertake active ownership practices or disclosure is close to 80%. However, less than half implement positive screening, which is investing in companies based on their high performance on ESG criteria. Similarly, relatively few are focused on impact investing, which directly looks to generate positive returns on ESG outcomes. That's shown towards the right-hand side of this chart. So this suggests to us that there is some reluctance, either a lack of will or perhaps a lack of ability for many of these public investors to go that step further and actively invest for ESG purposes. It's more a case of incorporating sustainability into their existing portfolios right now. Just looking a bit further into this survey of pension funds and sovereign funds and how they're approaching the green transition. I'm sure this is going to be a big part of the discussions that you hear later today. Again, here it's more a case of actively investing in renewable energies. That's shown on the left-hand side here by about 80% of the funds, and also in transitioning industries by a similar stage. There's less focus on divesting or excluding dirty or brown investments, which tells us one of two things. It tells us that many of these funds are looking to take that journey and try and assist some of the oil and gas companies that we've just heard in making that transition. But it also suggests, and we've heard earlier today, that there might even potentially be overcrowding in some of the renewable energy industries. That seems to be a big focus for a lot of investors right now. Digging deeper into the type of assets that the pension funds and sovereign funds are looking at, one of the big questions we ask is their attitudes towards different asset classes. So here, this chart is showing the shares who expect to increase, maintain, or simply do not invest in various different ESG asset classes. So those in blue show the share that are looking to increase their allocation to a certain asset class over the next 12 to 24 months. The dark blue looking to maintain, and the light green bars showing those who do not invest. Interestingly, we have it there labeled as decrease. None of the funds we surveyed suggested they were going to decrease their ESG investments in any asset class. Those higher up, green bonds and green real assets, that includes things like sustainable infrastructure, are those that are most in demand right now. For green bonds, they tend to be obviously the most liquid and one of the most advanced asset classes. Green real assets, linked to what I said before about how renewable energy investments seem to be in demand right now. Those seem to be the places of interest to the public pension funds and sovereign funds we surveyed, less so areas like public equities or sustainable VC or private markets. And it's very similar when we look at the central bank reserve managers. This chart here is again showing a similar question when we asked about their attitudes towards certain asset classes and whether they're looking to increase their allocation to them over the next 12 to 24 months, and that's what the bars are showing. And there's an important distinction here made that we saw on a regional basis. So those in lighter blue are showing those answers by European reserve managers, and those in darker blue are showing those by APAC. In both regions, again, green bonds are the assets that seem to be most in demand right now. That's shown on the left-hand side of the chart. That's especially the case in Europe, where over 60% mentioned that they would like to increase their allocation to green bonds over the next 2 years. But also what is common across all asset classes is that Europe seems to be doing more than APAC. For every type of ESG asset class we've got listed here, there's greater interest among European reserve managers than those in APAC. It's worth mentioning that this is not just an APAC phenomenon. Also for those reserve managers that we surveyed from Sub-Saharan Africa or Latin America, there's less demand than there is for those in Europe. I think, again, part of this relates to central bank mandates. Often they're more restricted in some of the emerging markets who focus more on capital preservation or liquidity when it comes to reserve management, whereas those in Europe, who many of which already have a significant buffer of reserves, are now looking to explore new areas, and sustainability seems to be one area where that's the case. other than mandates, it's worth looking at other factors that are holding back reserve managers from exploring different types of ESG assets. And one common area that we consistently see is data. And that's shown by this chart here, where we asked the reserve managers, what are the main barriers to further ESG adoption in your portfolios? We've run this survey, I should say, at OMFIF for a number of years, and so I've shown the results here from last 3 years that we've run the same question in the same survey. Right at the top, you can see insufficient data and information has consistently been the big issue for reserve managers. They maybe want to do more on sustainability, but they don't have the resources or the information to do that. And actually, interestingly, it seems to be a growing concern right now. You can see that the gray bars, which show the results that we received from the survey this year, are higher than those of the blue bars from what we saw in previous years. The second most prohibitive factor, as mentioned before, is that for many of these reserve managers, it simply does not fit with their fund strategy. They're focused elsewhere on capital preservation or liquidity. There are other factors like lack of suitable projects or legal or regulatory factors, which are lesser concerns right now. It really is data that seems to be the main issue. And interestingly, we find a similar thing for the pension funds and sovereign funds, which are shown in this chart here. Again, it's the same question. This is just showing the results that we've got for this year. What are the main barriers to ESG adoption and integration in your portfolios? Again, over 70% says insufficient data and information. Interestingly, greenwashing concerns are fairly high up on there, which in some ways is linked to lack of reliable or trustworthy information to be able to differentiate between those companies who actually are doing more on sustainability and those that are maybe gaming the system in some way. It's interesting that lack of suitable projects or expectation of lower returns are more of an issue for the pension funds and sovereign funds than they were for reserve managers that we've seen. But again, data and information is the big concern. Now, the final chart that I want to share with you all today is on the use of external managers who could potentially help to overcome some of these challenges that I've just mentioned. This chart here is showing which of the following asset classes for which the different groups of investors use external managers. So the public pension and sovereign funds on the light blue bars again, the reserve managers and the dark blue bars again. And you can see generally public pension and sovereign funds use external managers for a wide variety of assets. They invest across a wider variety of assets than the reserve managers, so that's perhaps unsurprising. But what I wanted to show for you here is, highlighted in red, is that sustainable assets are used by almost half of the funds we surveyed. They use external managers to help them navigate that space, but that seems to be a lot less than other areas like private equity, private markets, infrastructure, or just general public equities. For reserve managers, it's a similar story. In some cases, this is because sustainable assets still aren't a major part of their portfolios. They tend to invest more in public equities and private markets and infrastructure, and that's why they tend to use external managers more for that area. But it's still suggesting that there is limited use of others to help them navigate the space. And I think this is one to watch for in the coming years, and it's certainly one that we'll continue to survey at OMFIF and find out more. Because if it is the case that, particularly for the reserve managers, that they do try and do more on ESG, it may be the case that they use external managers to help them with that process, particularly if they find that internally there's a lack of information or data to help them do that right now. And it's a similar case with the public pension and sovereign funds. I'm sure you'll hear today from some of those who we have speaking with us that there's a growing interest in ESG, but it might be trying to navigate that space is difficult, and maybe that's where there's scope for others to help on that journey. So to conclude, I think there's three main takeaways that I want you to take from this presentation. The first is that climate change is a middling concern for global public investors. It's not as pressing an issue as geopolitics or inflation right now, but equally it's not at the back of the minds of either public pension funds and sovereign funds or the reserve managers. For both groups of investors, right now green bonds seem to be the asset class with the highest demand in the next few years, although for the pension funds and sovereign funds there does seem to be considerable demand for green real assets like sustainable infrastructure and renewable energy projects. For both groups of investors, insufficient data remains the key challenge. And that's something that, again, I'm sure we'll hear today by various others, what are the ways to navigate that, but that does seem to be the pressing concern for a wide range of investors right now. I'd encourage you all to take a look at our research. We don't just look at sustainability for these group of investors. We look at their macro concerns, asset allocation concerns over a broad range of issues and their operating models and how they're looking to deal with some of these challenges. And I hope you will all join us for the launch of the report on global public pension funds that we'll be doing on the 30th of November. But that concludes my presentation, and with that, I'll hand back to Clive. Thank you.